Ever wondered how to calculate the value of something that pays you forever? In finance, there's a powerful concept called perpetuity, which helps us calculate the present value of endless cash flows, be it from real estate, investments, or dividends. In this video, we'll break down what perpetuity is, how to calculate it, and I'll walk you through an Excel example to make sure that you can start applying this concept in your analysis straight away. Let's get started. The perpetuity concept essentially helps us represent current value, the present value of an indefinite future number of cash flows. For example, we may have a bond that pays dividends forever and we need to calculate its current value. Or we might be doing the future cash flows forecasting for a company, and our outlook can be like 1, 3, 5 years, but we cannot plan indefinitely. So that's where the perpetuity concept also comes into play through something called terminal value that we're gonna touch on later. Present value of any cash flows is this cash flow divided over the discount rate for the period. This is like the backbone of calculating present values. So we can present perpetuity as the sum of indefinite 1 to infinity number of cash flows over 1 plus the discount rate to the power of the current period. And this is how we usually discount and calculate net present value, for example, but instead of infinity here, we would have like 5 periods or something like that. There's a way to really simplify this formula. If we look here, we have the present value is equal to the cash flow multiplied by 1 minus 1 plus r, the discount rate, to the power of negative n, the period, over r. And if we only take this portion here, we can present it as 1 over 1 plus r to the power of n. And in the concept of perpetuity, n is infinity. So if we replace infinity here, essentially this becomes infinitely large. So 1 over infinity is essentially 0. So we can substitute this whole thing with 0, and that way we get the present value of an indefinite future cash flow is the cash flow multiplied by 1 minus 0 over r, and this is how we get to the present value formula for a perpetual cash flow, which is the cash flow over r, or the discount rate, which is usually our cost of capital. And this is a no growth perpetuity, so it's essentially the same cash flow being paid every period indefinitely. We can also have like growth perpetuity. So in this scenario, we have some growth that's applied to the cash flow every period. And as long as our discount rate is above this growth percentage, we can use this formula to calculate the present value of these perpetual cash flows. The cash flow over the discount rate minus the growth percentage. And we can briefly touch on terminal value here, which takes this into account. So when we're calculating terminal value, we usually have like a 5-year discounted cash flow model or something like that, and we use the cash flow in the last forecasted period multiplied by 1 plus g, the growth rate, to get to the terminal value period, so the first non-forecasted period, and then we assume that this cash flow is just gonna go into perpetuity with this growth rate, and we essentially get cash flow 1, which is gonna be the cash flow at the terminal value period over r minus g, which is the same as what we had up there. So let's look at 2 quick examples. One is we have a property that costs 1.2 million and it's expected to generate an annual net rental income of 75,000 with a capitalization rate of 5%, which is an average capitalization rate for the area. And we can use that as our discount factor. So the present value of a no growth perpetuity will be the net rental income divided over 5%, which is 1.5 million. And of course, we do not expect that every year for the rest of time, this property will generate 75,000, but this is a really good way to estimate the value as of now, assuming that even if we decide to sell the property the next owner would also apply the same principle. That's how we can get to a value of the no perpetuity of 1.5 million, which is considerably above the 1.2 million that it's priced at. So this is a sensible investment. Another example can be that we are investing 60,000 in a company, and this company will pay us out 4,500 of dividend each year, with this expected to grow 3% per period. And our discount rate here, 11.5%, is essentially our cost of capital, our hurdle rate that we have to pass in order for an investment to be economically sound. The present value of the perpetual dividend is our dividend payout, and you're going to multiply that by 1 plus our growth rate, and then divide it over our discount rate minus our growth rate. And this will give us 54,500, which is below the investment cost. So if our average cost of capital, our hurdle rate, is 11.5, then this is not an investment that makes sense for us. These are 60,000 that we can invest better elsewhere. And that's how the concept of perpetuity works in financial modeling. And those are just two simple examples on how you can apply that in a real-life scenario. If you want to dive deeper into financial modeling, I've created a free financial modeling course for beginners available right here on YouTube. You can check it out in this playlist up here. It will take you from an empty Excel spreadsheet all the way through to a fully developed 5-year financial model that's assumptions-driven and you can use for any business. Thanks for watching, and I'll see you in the first video.